Mexico's public debt is not at risk, but its rapid and sustained increase during the last 6 years is worrisome. Analysts have recently raised the alarm. If the problem is not addressed, some said it could drag down economic growth or cause a new debt crisis. Public debt closed at 34.3% of GDP in 2016. This year, it's expected to be at 48.5%. As a result of accelerated growth in debt, agencies like Moody's and Standard & Poor have decided to change Mexico's evaluation to negative. Director of the Observatory Mexico YAHAWAH, Valeria Moy said the economic situation is not as bad as in the 70s and 80s, but Enrique Pena Nieto's administration has begun to break down the country's stability a bit. We are not at worrying levels, but the rating agencies already gave us a slap on the wrist. The 4 years that have passed during Enrique Pena Nieto's administration have been characterized as a period of massive debt, which has been growing faster than the economy, according to Moy. If you let the debt-GDP ratio pass from 40 to 70%, then it may be a drag on the economy. Jaime Reduce, sovereign credit risk analyst for Moody's Mexico, warned. Mexico national debt goes up. In 2015, Mexico public debt was $617,898 million, has increased $24,521 million since 2014. This amount means that the debt in 2015 reached 54.00% of Mexico GDP, a 4.49 percentage point rise from 2014, when it was 49.51% of GDP. If we check the tables, we can see the evolution of Mexico debt. It has risen since 2005 in global debt terms, when it was $337,589 million, and also in terms of GDP percentage, when it amounted to 39.02%. According to the last data point published, Mexico per capita debt in 2015 was $4,865 per inhabitant. In 2014 it was $5,125, afterwards rising by $260, and if we again check 2005 we can see that then the debt per person was $3,080. The position of Mexico, as compared with the rest of the world, has worsened in 2015 in terms of GDP percentage. Currently it is country number 112 in the list of debt to GDP and 128 in debt per capita, out of the 184 we published. In this page we show you the progression of the public debt in Mexico. You can see debt in other countries in public debt and see all the information about Mexico in Economy of Mexico. Current account deficit widens amid recovering domestic demand. The current account registered a deficit of $1.8 billion in the third quarter, which was larger than the previous quarter's deficit of $0.6 billion, but smaller than the $3.6 billion deficit incurred in the same quarter last year. Moreover, the reading came in above market expectations, which had the current account deficit reaching $3.0 billion in the third quarter. The quarterly figure was mostly led by a widening of the trade balance deficit. Q2, $0.1 billion, Q3, $2.3 billion. Exports reached $75.5 billion, which represented a minor improvement over the previous quarter. Q2, $74.7 billion, while imports rose more markedly from $74.7 billion in the second quarter to $77.8 billion in the third quarter. Furthermore, a wider deficit in the services balance also contributed to the deterioration of the current account, as it increased from $2.7 billion in the second quarter to $3.0 billion in the third quarter. Yet, the widening deficit was partially offset by an improvement in the income balance deficit Q2, $3.8 billion, Q3, $2.1 billion. Meanwhile, the transfers balance fell from a $5.9 billion surplus in the second quarter to a $5.6 billion surplus in the third quarter, driven almost entirely by lower remittances from workers abroad, which dropped to $5.5 billion Q2, $5.8 billion. Going to the moderate quarterly reading, the moving annual current account deficit shrank from $5.3 billion in the second quarter to $3.5 billion in the third quarter. Mexico's surging debt load is raising red flags for Deutsche Bank AG and Barclays plc. The broadest measure of debt as a percentage of gross domestic product has swelled to 46% from 38% in President Enrique Pena Nieto's first 3 years in office as plunging oil prices eroded government revenue and a weak peso made it more expensive to borrow in dollars. That compares with a 2 percentage point increase in the 3 years before he took office, government data show. According to the Bank of International Settlements, the debt burden is the highest since 1995, during the so-called tequila crisis, when panicked investors sold off their short-term debt and sparked a peso depreciation. The International Monetary Fund estimates that the figure is at least as high as 1996. Rising leverage threatens to once again erode investors' confidence in a country that currently enjoys borrowing costs that are among the lowest in the region. Mexico, one of 4 investment-grade major economies in Latin America, is also the biggest issuer in international debt markets and pays on average 3.6 percentage points above U.S. Treasuries, according to data compiled by J.P. Morgan Chase & Co. That's almost 2 percentage points less than the regional average. The speed of growth could be troubling, said Alexis Milo, Deutsche Bank's chief Mexico economist, referring to debt levels. The deterioration in Mexico's fiscal perspective could have an impact on the cost of financing its debt, especially as sooner or later interest rates will rise around the world. Mexico's public debt chief, Alberto Torres, said debt has risen in other emerging markets at a similar pace, while Mexico has distinguished itself by pledging spending cuts and carrying out a plan to close the fiscal deficit gap. Torres said debt levels couldn't be compared to the tequila crisis era because conditions are far different. Debt itself is mostly peso-denominated and far longer term now, while indicators like inflation are much more controlled. There's a clear signal of broad strength in the economy today that wasn't there in the past, Torres said in an interview. The peso weakened 0.8% to 18.2747 per dollar in Mexico City. Worrisome. Mexico's sovereign notes have lost an average of 5.48% in the past 12 months, compared with a gain of 0.9% for emerging markets, according to J.P. Morgan. The government's vow last week to eliminate more than 132 billion pesos $7 billion of spending from this year's budget hasn't totally eased concerns, said Marco Oviedo, the chief Mexico economist at Barclays. If economic growth comes in below forecasts, the package of cuts may not be enough to reduce liabilities as a percentage of GDP and, as a result, the debt burden could end up rising instead, he said. It's worrisome that this trend has continued, Oviedo said. We need to see those cuts reflected in debt levels. Based on International Monetary Fund estimates, Mexico's gross debt equals 52% of GDP. That compares with 17% for Chile, whose investment grade from Moody's Investors Service is 3 steps above Mexico's, and 20% for Peru. which shares the same rating as Mexico at Moody's and Standard & Poor's. Brazil, which lost its only remaining investment grade among the major rating firms this week, is struggling under a debt load of 67% of GDP. Relatively low. Not everyone is alarmed by the surge in debt. Mexico is taking the necessary steps to address its fiscal position after debt deteriorated in 2014, said Carlos Capistran, chief Latin America economist at Bank of America Corporation. The debt will continue rising, but the pace will slow, Capistran said. Fitch Ratings affirmed Mexico's credit rating at BBB+ on Friday, saying its economic performance has remained relatively resilient and authorities have taken measures to cushion the impact of low oil prices on its public finances. Fitch said Mexico's government debt burden should peak in 2016 and reduce gradually thereafter, although it warned of risks that weak economic performance and fiscal deterioration could lead to worsening government debt dynamics. For now, Oviedo of Barclays says it will be important for the nation to follow through with those cuts. Mexico saw similar reductions last year, only to boost spending in other areas for an overall net increase of expenditures after higher-than-expected revenue allowed it to do so while still reaching the deficit goal, said Milo. One of the solid fundamentals of the Mexican economy is that public debt as a percentage of GDP is relatively lower, Milo said. If it keeps growing at these rates, that won't be the case anymore. We are not at worrying levels, but the rating agencies already gave us a slap on the wrist. The 4 years that have passed during Enrique Pena Nieto's administration have been characterized as a period of massive debt, which has been growing faster than the economy, according to Moy. If you let the debt-GDP ratio pass from 40 to Mexico's public debt is not at risk, but its rapid and sustained increase during the last 6 years is worrisome. Analysts have recently raised the alarm. If the problem is not addressed, some said it could drag down economic growth or cause a new debt crisis. Public debt closed at 34.3% of GDP in 2016. This year, it's expected to be at 48.5%. As a result of accelerated 70%, then it may be a drag on the economy, Jaime Reduce, sovereign credit risk analyst for Moody's Mexico, warned. Mexico national debt goes up. In 2015 Mexico public debt was $617,898 million, has increased 24,000 growth in debt. Agencies like Moody's and Standard & Poor's have decided to change Mexico's valuation to negative. Director of the Observatory Mexico YAHAWASHI, Valeria Moy said the economic situation is not as bad as in the 70s and 80s, but Enrique Pena Nieto's administration has begun to break down the country's stability.